Zacks Know Your Options, a weekly overview of unique option strategies and ideas designed to help you beat the market no matter which direction it's going. We're going to talk about an interesting concept here, but you may have to check your calendar before you can fully understand all about calendar spreads. Kevin Matras, who is our top technician here, top options expert, stock screener, you name it, he's the top of the list on it, is going to be explaining this whole concept to us. Yeah, calendar spreads. Now, that's been an options strategy slash tool since I've been watching the markets. But new for us here. We haven't talked about it yet, right?
Yeah, it's brand new for us. We really haven't talked about it before. But what's interesting is that, you know, even for guys who have never traded options before, I'm sure they've probably heard somebody say the word calendar spread at some point in time. They probably didn't know what the guy was talking about, but we're going to clear that up today.
Is this a basic strategy or advanced?
It's, I would say it's intermediate. There's nothing, you know, rocket science about it, but it's a little bit more complex than just buying a straight call or a straight put, but let me explain this, okay?
Sure.
First off, let's start with a definition. So a calendar spread can also be referred to as a time spread or a horizontal spread. And a calendar spread is when you sell or write an option in 1 month, and then you're going to be buying the exact same strike price in a different, further out month. Since the option you're writing has less time, it's going to be worth less, and the one you're buying has more time, it's going to be worth more. This can also be referred to as a debit spread as well, because you're going to be paying more for the one option than you're collecting for the other.
Okay.
Now you can do this with puts as well. You can sell a put in a nearby month and buy the same strike in a further out month. But for this example, we're going to be talking about using call options. And as you might expect, if you are doing it with calls, you have a neutral to bullish bias. If you are doing it with puts, you have a neutral to bearish bias. Now, you can also sell this strategy short if you wanted to, but again, for this piece, we're going to be focusing on calls, and we're going to be focusing on the long end of this strategy.
All right, so give us an example to clarify how this works.
Okay, we're going to use IBM as an example, so let's set this trade up.
All right.
Let's say you wrote a December 125 call for 220. That means you're going to collect 220 bucks. And let's say that you bought the April 125 call for 650. You're going to pay 650 bucks. Your net cost or debit is going to be 430 or 430 bucks. At expiration, let's say that when this trade expires, let's say at expiration, IBM is under 125. At expiration, the December 125 call that I wrote for 220 is now going to be worth 0. And the April 125 call that I bought for 650 is now going to be worth, let's say, $540. So my calendar spread is now worth $540. If you were to take the $540 value less my cost of $430, that means I have a profit of $110 or a 25% return. Now, if I wanted to, I could actually hold on to that further out call if I thought the market was going to begin a rally. So if the market started to go higher, I could actually see a much larger profit because that call that I still own should increase in value. But again, if let's just say that the market started to go down, at least I know the worst case scenario would be that I could only lose that $430. Now, let me just say this too. The real benefit with this strategy is that you know you could never lose more than what you paid, and that is the kind of safety, if you will, that I think attracts people to this kind of strategy. And again, based on how far out you go, that will determine what the strategy is going to cost. But there's a lot of really good inherent safety measures with this strategy, and I think it makes it a really interesting strategy to put on.
So it seems pretty straightforward.
It really is. You know, what's interesting is I think a lot of people you know, don't really look at this strategy that much, because when you look at the profit, right, you put $430 in and you're only making $110, sometimes people will look at that and think to themselves, well, the profit potential isn't that big. But if you were to look at it from a percentage standpoint, 20 or 25% is big. So think about it. If, let's just say that you put 10 of these calendar spreads on at $430, that means you're spending $4,300 for 10 of these spreads. If you were making $110 on each one of these spreads, once that trade is said and done, that's an $1,100 profit, and that, again, that's a 25% return, and an $1,100 profit on a $4,300 investment. I believe that that's a very exciting trade indeed.
All right, do you own this, or are you in this position?
I don't have this particular strategy on right now, but I do have IBM.
All right. So if seeing this whole concept in text form helps you understand it more, go to Zacks.com's homepage and scroll down the homepage until you get to the headline that talks about checking your calendar, and it'll take you right to that information. Just more information to help you know your options. With Kevin Matras, I'm Terry Ruffalo.